Commercial real estate is getting pummeled by the pandemic. Offices are staying empty as workers stay home.
We had a period of utter quiet.
Brick and mortar stores are closing in droves.
Retail is like the 9/11. It's a hurricane.
Hotels and restaurants are struggling to survive.
There absolutely are, quote, new temporary normals, unquote, and we have to adjust and address that.
There is hope that demand will rebound as people reimagine the ways they work, play, and shop.
New businesses will come in, probably younger businesses, probably scrappier businesses.
A lot of our tenants are talking about more of a distributed workforce where they think about thinking more regionally.
But the year so far has been brutal, and at least in the near term, the outlook remains grim.
It's fair to say, I don't know that we've necessarily hit bottom yet.
Real estate is facing a moment of reckoning. Join us for a special report on how the industry got here and where it's going. I'm Lisa Abramowitz. Welcome to a Bloomberg special report, The Real Estate Reckoning. Many aspects of the economy have gotten hammered amid the COVID-19 pandemic, but perhaps none more so than pockets of the commercial real estate market. Businesses shuttered offices and ordered employees to work from home. Widespread lockdowns put intense pressure on retail, hotel, and restaurant industries. The recession that quickly followed and the uncertain shape of a recovery has changed the landscape for landlords and tenants alike. And so, just like that, commercial real estate is confronting a new reality. The commercial real estate market faces its biggest transformative moment in recent memory. In the near term, it's tough to value properties amid a pandemic-driven upheaval. Delinquencies among hotels and retailers have ticked up. Real estate values have begun to drop, in some areas the most since the last recession. There are pockets of resilience and even price gains, particularly among certain industrial properties, with investors rushing to embrace the physical infrastructure of a more online economy. But in the longer run, there's concern about bigger losses ahead. And uncertainty has effectively paralyzed the market. It's hard for investors to know whether they're getting a bargain or catching a falling knife. Buyers are demanding steep discounts and property owners are reluctant to sell. Transaction volumes generally fell 68% in the second quarter, with the sharpest declines coming in retail and hospitality. Meanwhile, global investment volume sunk to its lowest level since 2010. There's a lot of money still out there waiting to pounce. How it gets deployed will determine the fate of trillions of dollars worth of property. Among the many variables that will determine the future of real estate is how closely the post-pandemic new normal resembles the old normal. For instance, will consumers return to physical retail when they perceive it safer? Or will online shopping become the dominant model? In the second quarter, asking rents plummeted in Manhattan's main retail neighborhoods. Several areas saw declines of more than 20% from a year earlier. That's according to brokerage Cushman & Wakefield. Real estate billionaire Barry Sternlicht, who founded Starwood Capital, spoke with my colleague Eric Schatzker in June. He was pretty blunt about the challenges facing the retail property market.
Retail is like the 9/11. It's a hurricane. I think great physical retail will survive. Rents may not be what they were. Really difficult asset class today. Office, I'm not worried about. Office tenants are paying. I don't think people enjoy working from home. I am personally not worried about office, even though companies may take less space. There are geographies like New York City, I'm worried about office, but really for other reasons. I think rents could drop 25% in New York, office rents. I think expenses could go up 25%. You could see office values drop 40% because of that. Pressure on real estate taxes in particular that can't be passed on to tenants.
Barry Sternlicht is not alone in his bearish forecast for New York office values. Moody's Analytics projects that effective office rents will fall 21% in New York this year and just over 10% nationally. They also expect vacancy rates to hit record levels across the country, with the push toward telecommuting likely to continue into next year. Top executives from CBRE, the world's largest commercial real estate services firm, gave Bloomberg details of trends they're seeing on the ground.
We had a period of utter quiet. And again, it's always an exaggeration in a very big world that we live in. But we are now beginning to see deals get signed up. And most of the deals, in fact, I would say the vast majority at this point, are what we call pre-COVID deals. So there were deals that were well on the way to happening, and then people pushed the pause button and said, let's just wait and see what happens. I can tell you that there are retrades that happen at the last minute, as you would expect. Interestingly enough, most of the retrades have focused on free rent, and they focused on give us more time without a rent start. I should tell you, if you said to me, what is the preponderance of deals? And to me, this is extremely interesting. It's short-term renewals, 1 year, 3 years, 5 years. I think something like 62% of the deals we've done in the recent have fall into that category.
Occupancy rates in New York for office space haven't really changed materially. What's changed is with the great uncertainty about when and how people will go back to work, the amount of new long-term leases being signed, some sublease spaces coming onto the market, some renewals are getting done, extensions are getting done, but long-term decisions are really on hold until people figure out what's going to happen long-term with the way they use space and when they're going to be able to come back. We've been on a long-term trend to have less space per person. That's going to reverse now. We're quite confident of that. But companies will optimize. They'll say if on average we used to have 70% of our people in the office, and now because some are working from home, we're going to have 60% in. They'll take space for less people, but they'll take more space per person. We don't know exactly how that offset will work. In the long run, our guess sitting here today is that over several years, the use of office space, the amount of office space will settle in around where it is now. Of course, we have an awful lot left to learn.
The word everyone keeps repeating is uncertainty. No one can project what demand for real estate in New York and other major cities will look like. There's fear that the loss of service jobs and the flight of wealth to suburbs will lead to the decline of cities as economic powerhouses. Residential landlords in U.S. cities are already feeling the pinch. Their revenue from rent collection in June fell 1.4% year over year, while the figure jumped 2.2% for their counterparts in the suburbs. I reached out to a noted academic expert on urban and public economics, Harvard's Edward Glaser, for some perspective. He told me that while he's watching the pandemic with concern, he doesn't think cities are dying.
I think it's very unlikely unless this thing turns into a multi-year recurring catastrophe. So if a relatively rosy outlook occurs, meaning that we get a vaccine in 2021, we make the investments to make sure that nothing like this pandemic happens again in our lifetimes, then yes, cities recover. In the worst scenario, things are going to be tough, right? We have massive numbers of small business closures. We have the move to working at home. All of these things are going to challenge cities, the fear of going on public transportation, but it will not be as bad as the 1970s, which were a bleak decade for cities, and cities will get through it.
Do you think that some of the discussions of the working from home trend and what that means for offices has been overstated, or is this a real trend that you think will fundamentally reshape cities?
It's a bit of both. The current event, the current pandemic, has moved us all to Zooming, has moved many of us to Zooming, and we've discovered we can sort of live this way, sort of, right? And in 2 polls we did of business economists and small business owners, more than 40% of firms answered that 40% or more of the workers that are currently working from home during the pandemic will stay working from home after the pandemic. So this will turn into a major shift for a lot of workers. Now, that doesn't mean that city skyscrapers will remain empty. That means that those skyscrapers will go to different tenants. It means that prices will probably fall, and there's no question that I would expect there to be at least some kind of a correction in commercial real estate prices. But new businesses will come in, probably younger businesses, probably scrappier businesses. I think the demand for cities as places to live, assuming again that they become safe, that will continue regardless of this. And we saw this, when the lockdowns were taken away, people rushed to be back with other people. People rushed back to having urban pleasures. They rushed too quickly, for sure. But it just shows the latent demand to actually be in a real city, surrounded by real people, having real fun.
Coming up, Zoom fatigue. Some urban landlords are getting impatient with the whole work from home trend, and they've got a message for corporate tenants.
I'm tired of Zooms with people who are in their beach homes getting delivered iced tea by somebody who's off camera. Get to your desk.
This is Bloomberg. Welcome back to a Bloomberg special report, The Real Estate Reckoning. I'm Lisa Abramowitz. Bloomberg recently reported that several of New York's top property owners and managers have been lobbying the city's business leaders to speed up plans to bring workers back to the office. They warn that unless financial companies, law firms, and other large employers step up, smaller businesses will collapse and the economy will spiral into decay. Empire State Realty CEO Anthony Malkin presented that case on Bloomberg Surveillance.
The death of work from home has been written. Amazon, Facebook, smartest companies, biggest companies have stated very clearly they're expanding, and they're expanding in cities, they're expanding in New York City. And the fact of the matter is that you cannot understand hallway validation, what happens before the Zoom, after the Zoom, unless you're actually in the office. I'm tired of Zooms with people who are in their beach homes getting delivered iced tea by somebody who's off camera. Get to your desk. I think we've got 4 phases: lockdown, pre-therapy vaccine, post-therapy vaccine, and then cleanup and replanting the field, if you will. We're definitely in that phase 2 right now, and we've got a ways to go till we get to phase 3. So there absolutely are, quote, new temporary normals, unquote, and we have to adjust and address that. You can make these changes, you can make these adjustments, and people need to adjust and adapt. That's true. That doesn't mean that you don't try, you don't start. Those people who do are going to win.
Scott Rechler, CEO of RXR Realty, also told Bloomberg News he thinks large companies have a civic obligation to help restart New York's economic engine. RXR controls over 25 million square feet of commercial property in the city and the surrounding suburbs. I spoke with Rechler about the distribution of demand in the metropolitan area and asked him if corporate tenants may be shifting their focus from the density of Manhattan.
A lot of our tenants are talking about more of a distributed workforce where they think about thinking more regionally rather than just urban. So they'll have their main offices in the city center, but then they'll think about where are the zip codes of the people that live around that and look at the suburban nodes around that have public transportation back to the city. So we're having conversations with a number of them about relocating to some of those areas.
Do you think that that's going to be a long-lasting trend, this whole spoken wheel kind of model where they've got an urban kind of headquarters and then beefed up suburban offices?
I think there's a good business sense to do it, and there's a good public policy sense to do it. From the business sense, if it's all about attracting talent, if you're able to give a better quality of life to your employees so they can work closer to home, not have to take a commute, get more family time, and be more productive in that environment, and also a lower cost of living, that works. And from a public policy standpoint, one of the big challenges that cities like New York have faced has been the strain on its commuters system, its transit systems, the congestion in its streets, the affordability of its housing, right? And so if you're able to reduce that strain by taking more of a regional lens and putting some of that density out in areas that are less dense, that actually, I think, will make this more sustainable for urban centers like New York.
All right, Scott, this sounds great. And I think it also strikes fear in the hearts of people who own big buildings, especially in Midtown or in any of the city centers or the sort of business centers. And I know you're among those. How concerned are you by just sort of a plunge in valuations, given how much building there's been and given the likely need for less office space, perhaps right in the center of the city?
Right. So you've seen 2 other trends in the city that to combat that a little bit. One is there used to be a moment in time where everyone was trying to get as much people into as little space as possible, this densification of space. And, then that was to be able to save money. That has reversed itself where now people look at when they come to the office space, they want people to come for an experience. They want people to come for collaboration. They want them to have a work environment that isn't just about filling as many people into one little space as possible. So they work on their computer all day long and not engage. So that requires more space. So we've seen now those companies having to take more space. There's also been an acceleration of tenants looking for space that have the best infrastructure, health, wellness, and experience and location. So the divergence between Class A space and Class B space is widening. So I think the landlords that own the higher quality spaces, that have that infrastructure, that are well located by public transportation, are going to fare better. I think over the next couple of years, we'll see pressure, but more, I think, because we're sort of going to be living in where the lifestyle of New York in terms of restaurants and Broadway and all that is on hold while we're working through the virus. But I think once that is over, we'll reverse and the people will come back and we'll have that excitement again.
So if we get that de-densification that you're talking about, will companies be willing to pay the same amount for space if they have fewer employees working in it?
When you really look at the companies that locate in New York, it's already an expensive market to locate. They're locating here because this is where the talent has been historically. And whether that's Google or Facebook's most recent announcement where they're paying over $110 a square foot for space on the West Side, or JP Morgan or Pfizer, they're here to attract that talent. And so with that objective, I think they will be willing to pay it because it's a small amount relative to their overall cost and being able to get the talent pool that's going to drive their growth and innovation going forward.
Have you seen rents actually increase in suburban areas?
We've seen demand very strong in our suburban markets. I wouldn't say they've increased, but I would say we've seen our leasing activity very strong in those marketplaces. And even across, I would say, both New York and in the city and in the suburbs, we've collected 97% of our rent in all of our buildings, right? So I think it speaks to when you have Class A buildings with Class A tenants and institutional tenants, they pay their rent, they want to be there, even when they're not there because of they have to work from home for a period of time.
Coming up, has commercial real estate hit bottom? And will valuations ever bounce back to where they were? Brookfield's Nyla Flake Brown tells me it's probably time to lower expectations.
I don't know that values will necessarily get back to where they were in 2019 for every sector.
This is Bloomberg. Welcome back to a Bloomberg special report, The Real Estate Reckoning. I'm Lisa Abramowitz. While pessimism grips the urban property market, there may be cause for optimism in the suburbs. New Jersey Governor Phil Murphy struck a hopeful note when he spoke with Bloomberg in July.
I do believe that there is going to be a revisiting of some of what we had heretofore thought over the past couple of years of the stranded assets, the suburban mall, the low-slung sort of spaceship 3-story corporate headquarters, which our state was known for so long. There was a period of time here where folks looked at those assets and said, listen, the world has moved to a different place, a different paradigm. I believe strongly, not only will those assets be now looked at again with perhaps a different set of eyes, but they are being looked at, to be determined.
To get a clearer picture of the outlook for various types of properties, I spoke with Nyla Flake Brown. She's a managing director in Brookfield's real estate group, responsible for originating and underwriting loans and managing real estate finance funds. I asked her if she shares Governor Murphy's confidence that malls are poised for a comeback.
Many of the redevelopments that we're seeing of malls today are not traditional lease up with traditional retailers. And so we look at everything on a case-by-case basis, and many of the deals that are going to be attractive to us from a lending perspective will be the deals where mall owners are looking at other ways to drive foot traffic, whether that's by incorporating office or multifamily or doing developments or redeveloping the land to which those boxes sit on. And so, we look at everything on a case-by-case basis. We are very cautious in terms of how we underwrite retail. But again, I think some of that existed pre-COVID, and we just continue to take all of that into our analysis as we look at making loans on retail in today's environment.
And we've heard of Amazon leasing some of these properties for possible distribution centers. Is that something that you see as a promising investment?
Yeah, absolutely. I think right now, industrial is a very attractive sector. It's a very attractive way to potentially backfill some of the large boxes that have been left vacant from some of the department stores. And again, we started to see this trend pre-COVID. So as we look ahead, it's just going to be really interesting to see, whether or not that is a business plan that is viable. Now, Amazon can't occupy every big box. So again, we look forward to really seeing mall owners get creative as to the ability to take some of those boxes and use them for industrial warehouse spaces.
Well, and then there's the question of valuation, right? I mean, should a warehouse that's used for a distribution center be valued in the same way that a Nordstrom with, concierge service be valued? What's your view on that?
Yeah, I mean, you're absolutely correct. When you look at what's going to happen with retail as a whole, valuations are going to have to, we're going to have to think about valuations differently. The traditional retail box for anything other than a Class A retail that will probably be able to exist long-term as in a form that we think about in terms of traditional retail. We'll think about those values similarly. We'll take into account everything that's happening, in this COVID environment and struggles that retailers may be experiencing. But when you look at these alternative and best uses, it really is going to be on a case-by-case basis, because you have to now compare valuations to other industrial markets, because obviously the attraction to being in some of these locations is still going to be that the rents make sense for these warehousers to be in these locations. So we're going to see a change in how we look at values on these assets.
How much further do you expect valuations to fall in some of these key markets?
That's a tough question to answer. But look, I think it's fair to say, I don't know that we've necessarily hit bottom yet. I do think that we're going to continue to see market fundamentals decline. And so, I think we just have to really be cautious and keep an eye on the markets. I think there's some asset classes that will do better than others. One thing about office, for example, is offices are, occupied by tenants who sign longer term leases. And so there's going to be a little bit of a delay before I think we see some of the cap rate compression or cap rate increases in office. I do think right now residential, again, vacancies are up. Rental rates are down, but again, that's another sector where I'm really optimistic that as we get through the coronavirus, we'll start to see an improvement.
Just to finish up, I'm wondering how long you think it'll take until valuations get back to where they were in 2019.
I'm hopeful that, we're in this another 12 to 18 months potentially, but I don't know that values will necessarily get back to where they were in 2019 for every sector. Again, I'm very optimistic about industrial. I'm very optimistic long-term about residential, and also office. I think retail will obviously continue with the challenges that it was experiencing before, and we'll see kind of how that sector performs in the future. And again, we didn't really talk about hotels, but that's another interesting sector, right, that has been hugely affected by the coronavirus. And so again, I think we're gonna have to wait and see what happens with leisure travel and corporate travel to really see how fast the hotel market springs back. But I think certain sectors will come back sooner than others.
That wraps up our special report, The Real Estate Reckoning. Stay tuned to Bloomberg Television and Radio for ongoing coverage, and visit Bloomberg.com for all the latest business news and analysis 24 hours a day. Stay safe, everyone. I'm Lisa Abramowitz, and this is Bloomberg.